Ray Dalio has changed his mind because now he says the cash is not trash and it's a good time for you to start saving money. In 2020, Ray Dalio, who was a billionaire investor, he's the founder of Bridgewater, which is the largest hedge fund in the world. He came out and said that cash is trash when the pandemic started because he said, rightly, that we were going to face a lot of inflation, and so it would be a very bad time for you to be holding cash. And instead of holding cash during this period of high inflation that would be coming, you should have a diversified portfolio to protect you against the high inflation. And he was right, because in 2020, most people did not think that we were going to see any sort of inflation. We talked about inflation here, but you had the government, the Fed, and the mainstream media who kept saying that we were not going to see any inflation, that the stimulus could not cause any inflation. And so Ray Dalio was one of the few people back then who went against the grain to say that inflation was going to come and it was going to hurt people who had a lot of savings. Well, in October of 2022, Ray Dalio finally changed his stance on cash. He says that cash is no longer trash and that now is a good time for you to start saving in this changing economic cycle. What Ray Dalio is saying is that there are two things happening that are now going to start punishing borrowers and rewarding savers. These two things, number one, is first, the Federal Reserve Bank is working to increase interest rates, which punishes borrowers because now if you want to go out and borrow money, it's going to cost you a lot more. And if you have a lot of debt, well, the cost of servicing this debt is going to become more expensive. We're seeing the effects of higher interest rates all around us, and the Federal Reserve Bank keeps saying that they're going to continue raising interest rates until inflation falls. The second thing that Ray Dalio says is going to punish borrowers and incentivize and benefit savers is decreasing the Fed's balance sheet. So over the last number of years, the Federal Reserve Bank has built up a balance sheet of around $9 trillion. What that means is that especially since 2020, the Fed had printed trillions of dollars that they did not have, and they used these trillions of dollars to buy back bonds, to buy back mortgage-backed securities, to buy back a lot of things. They essentially bailed out things like our bond market and our mortgage-backed security market. And they then built up this huge balance sheet because they bought up all these assets. Well, now, as a way to fight inflation, the Fed is selling off these assets. So they're essentially removing money from our economy. What does that do? It reduces the supply of money to help cool down inflation. Now, while we haven't seen a significant drop in our balance sheet yet, the Federal Reserve Bank keeps saying that they're going to be getting more aggressive in this balance sheet pay down, which means less dollars floating around in our economy, which means the dollar becomes more valuable, which then also benefits not the borrower, but the saver, because now paying back that debt becomes more expensive. Now, if you're one of the people that locked in a very low mortgage rate between 2020 and the early part of 2022, that's great because now you have a fixed rate debt that even if interest rates go up, well, it doesn't affect you that much because your payments are fixed so long as you have enough money to make your payments. The problem is, what happens to the people that don't have fixed rate debts? One example that I haven't really touched on too much here, we did talk about it in market briefs, is what's going on in the UK. Because the United Kingdom doesn't give 30-year fixed rate mortgages like we do here. They do shorter term adjustable rate mortgages, and in 2023 there are millions of homeowners who are going to see their mortgage rates readjust, and their interest rates, kind of like here in the United States, have skyrocketed in 2022. So come 2023, you're going to see millions of homeowners in the UK see their new mortgage bill, which is significantly higher than what it was back in 2022. Here in the United States, if you wanted to go out and get a 30-year fixed rate mortgage today, you're going to be paying upwards of 7% for a 30-year fixed rate mortgage, which is more than double what you would have paid in the beginning part of 2022, while home prices have just started to come down. And if home prices continue to come down, you're going to see many more people who become underwater on their homes because home prices have come up so significantly, and then they may have to correct as a way to allow people to continue to afford homes because home prices have gone up so much thanks to the help of low interest rates, and now the interest rates are so much higher than they were before, home prices will have to correct. It's actually kind of crazy how fast our economic environment has been changing, because in the beginning part of 2022, you had so many institutions come out and say that a housing market is so strong that even if you raise interest rates, the higher interest rates could not cool down the housing market. Today, you have lenders coming out saying that this Not only higher interest rates, but the slowdown in the economy could potentially lead to more mortgage delinquencies, so some lenders are getting worried about that. It's the same thing for businesses, because now businesses who need to borrow money to continue running their operations could potentially be seeing 9% interest rates by the end of 2022, which means that if you need to go out and borrow money, it is so much more expensive to do that, and it causes almost like a rate shock. When you see how much money your loans are going to cost you, people have to think twice if it's even worthwhile to continue borrowing that money, if they should continue investing the money, whether it's in a home, whether it's in their business, or whether it's in another investment. And what we're going to see happen in the coming year and years is that if interest rates continue to grow and stay high, that all these businesses and institutions, not just here in the United States, but around the world, that have all this debt are going to be facing the price of servicing these higher debt costs. Because most people, most businesses who borrow money don't get a 30-year fixed rate mortgage. Their interest rates, their debt readjusts after a number of years. And as these debts start to readjust and businesses have to pay 2 times or 3 times higher interest rates on their debt, it's going to really impact the amount of money that they have to pay to service their debts, which is going to hurt the profits of these businesses. And if that happens at a time when businesses are already struggling from a slowing economy, we can start to see how everything compounds on top of one another. Now, we have been covering everything that's been going on with Market Briefs, which is my free financial newsletter. If you haven't joined Market Briefs yet, you should do so, because it's a free resource that I created to help investors stay up to date on what's happening in the markets. That way you can make better decisions with your money. So if you want to stay up to date on what's happening with things like the stock market, the real estate market, crypto, inflation, and the global economy, Market Briefs is a completely free resource that breaks down what's happening for you. So if you want to join Market Briefs, I get the link to how you can join down in the description below. All these factors coming together create bigger opportunities for investors with cash to come in and buy, because now what happens is the price of these assets go down, and if you want to buy this asset, the cost of getting debt to buy the asset is so expensive, making the asset less attractive because of the debt. But if you can buy it with cash or more cash, it makes it more attractive. But the second reason why is because when you see economic downturns, well, credit also starts to dry up. It becomes harder to borrow money. And so when it becomes harder to borrow money, because now banks become more picky, lenders become harder to find, banks don't have enough cash, well, now people who need to get cash from the bank have a tougher time getting the cash. But if you have access to cash, well, now it's easier for you to go out and buy things, because you have less buyers out there, because the buyers either don't want to pay all that higher interest for the debt, or they just can't get the debt. And so it creates more opportunities for cash buyers to buy investments, whether it's stocks, whether it's real estate. And it doesn't mean you have to have all cash, but more cash helps. And this is where Ray Dalio keeps saying now that cash is no longer trash, because now the interest rates that the Federal Reserve Bank is raising will also make it more beneficial for you to save. You can put your money into a high interest savings account for the short term as you look for good opportunities. But essentially what he's saying is that the prices of things coming down, so now it makes more sense to own cash. That way you can buy these assets on the way down. So how do you get more cash? Well, it's really a two-pronged approach. You can spend less money and you can earn more money. Now, spending less money is never fun, and it's especially more difficult when you have high inflation, but it becomes so important because that's the most accessible way to start getting more cash. And second, by earning more money, whether it's working harder at your job, trying to get a promotion, trying to get a raise, trying to get a bonus, or maybe you look for a second job or a side hustle, or you do something on the side. That way you can earn some more income, because the whole idea here is you're creating a bigger buffer between what you bring in and what you send out for your expenses. And this is cash where now you're looking for the right opportunities, because yes, inflation is still high. This cash is going to be losing value in the bank because of inflation. However, if asset prices keep falling, it'll create a bigger opportunity for you to come in and use your cash to buy some of these assets that you can then ride up with the market, which will then hopefully in turn make you wealthier in the long term, assuming you buy a good investment. So this is where all the different pieces of investment education, financial education start to come together, where you know how to use your money, you know how to invest your money, and you need to know how to be patient with your investments, because patience is the key, especially when you have an economic downturn coming like the one that we have right now, where inflation is high and you have an economic slowdown at the same time.
But again, my focus now isn't in real estate like it was before. A few years ago, I was heavy in real estate. Now I was doing everything that I can there, and a lot more opportunities were there. I bought a property in 2021, haven't bought anything in 2022 yet. But my focus now is building my business, because I see a bigger opportunity there for me than real estate. That's why I'm still involved in real estate.